Okay, let's unpack this. Today, we're doing a deep dive into, well, the world of e-commerce. Specifically, we're looking at Shopify's Q2 2025 financials, and they look pretty robust.
Yeah, robust is a good word for it. Definitely some eye-catching numbers in there.
Right. And just so you know where we're getting this from, we've got the official press release, fresh from Shopify, plus we're pulling in some financial news and analysis from places like TipRanks, investing.com, and the Motley Fool too.
Good sources, gives a rounded picture.
Exactly. And our mission for you today, we want to basically distill the key nuggets here, give you a shortcut to getting informed on these earnings, not just about the numbers themselves, but the story they tell, what it all means for commerce moving forward.
Precisely. The figures, they aren't just abstract points on a chart. They really do paint a picture of Shopify's health right now and give us clues about what's next.
Okay, so let's dive in. The big picture stuff first, the headline grabbers. Here's where it gets really interesting. Shopify reported, get this, 31% revenue growth for Q2 2025.
31%. Wow.
Yeah. And what really jumped out at me is that this is accelerating growth. It was 21% year over year back in Q2 2024. So they're picking up speed. What do you make of that acceleration?
Well, that acceleration is fascinating, isn't it? It really signals growing momentum. Like you said, they're not just keeping pace, they're actually gaining speed. And beyond that top line number, there's also the free cash flow margin. Impressive. 16% for Q2.
16%.
And that's consistent, right?
Exactly. This is the 8th quarter in a row they've hit double-digit free cash flow margins. It was 16% last year, too, Q2 2024.
Okay, remind us quickly, why is consistent free cash flow so important?
Right. So think of free cash flow as the actual cash the business generates after paying for its operations and any investments in things like equipment or buildings. Hitting double digits consistently, like Shopify is doing, it shows the business is fundamentally strong. It's generating real cash from its main operations. And that cash, it gives them options. They can reinvest, pay down debt, maybe even give some back to shareholders. It really shows financial discipline. Got it. And it looks like the market definitely noticed this strength. Shopify shares, they jumped nearly 22% after the market opened on Wednesday, August 6th, right after the results came out.
Yeah, pretty significant reaction.
Harley Finkelstein, Shopify's president, he had this great quote. He said, "Today's results are the payoff from bold bets we made years ago." It makes you think, okay, what were those bold bets he's talking about?
That's a really critical connection to make. Finkelstein's quote, it isn't just, standard corporate talk. It really highlights how long-term planning pays off. Now, he didn't list them specifically, but those bold bets, they likely include big multi-year pushes. Things like expanding Shop Pay, building out their fulfillment network.
Shopify fulfillment.
Yeah, or integrating more AI tools for merchants could even be their push into international markets. The results we're seeing now suggest those big decisions made way back are really starting to bear fruit. They're not just reacting anymore, they're actively shaping things.
That definitely helps frame how a company builds this kind of momentum. It's not overnight.
Not at all. It's strategic groundwork.
Okay, so let's peel back another layer then. Let's get into the engine behind these numbers, the more granular financials. First up, gross merchandise volume, GMV. That's the total value of all the stuff sold through Shopify, right?
Correct. Everything processed on the platform.
For Q2 2025, GMV hit $87.837 billion. That's a huge jump from $67.245 billion in Q2 last year. And importantly, it's matched the consensus estimate. Analysts were expecting around $81.65 billion. That's a massive beat, isn't it?
Oh, absolutely huge. And that GMV beat is, well, it's a really powerful indicator. It's not just a big number. It means merchants on Shopify aren't just like growing a number, but they're selling way more stuff through the platform. And that directly feeds into Shopify's own revenue, particularly their merchant solutions side. More sales mean more transactions for them to take a piece of. It shows the whole ecosystem is buzzing.
All right, speaking of revenue streams, let's break down that total figure, the $2.68 billion, which again beat the estimate of $2.55 billion. Shopify has two main ways it makes money. First, merchant solutions revenue. That climbed to $2.02 billion, beating the $1.89 billion expected.
Yeah, that's the bigger piece.
Then there's subscription solutions revenue. That came in at $656 million, which is actually just a tiny bit under the forecast of $659.1 million.
Okay, so understanding the difference there is pretty key for this deep dive. Subscription solutions is basically the fee merchants pay just to use the platform. Think of it like software as a service. Predictable income.
Monthly plan fee, you say.
Exactly. Merchant solutions, though, that's mostly tied to transactions, how much merchants sell, using Shopify payments, shipping services, maybe even capital loans. So the fact that merchant solutions did so well, beating expectations significantly, tells you merchant activity is really strong. They're using more of Shopify's extra services. Now, the subscription revenue miss was slight, yes, and we should note that, but the huge beat on the merchant solutions side more than made up for it. It really highlights that Shopify's growth right now is being driven heavily by merchants actually succeeding and selling more, not just by signing up new stores.
Interesting. And, sticking with those slight misses for a second, their monthly recurring revenue, MRR, that predictable subscription part, was $185 million. That missed the estimate of $192.3 million by a bit more.
Right.
But then you look at the bigger profit picture, and it still looks great. Gross profit.
Right.
Up to $1.302 billion operating income. $291 million beating estimates, and free cash flow, like we said, $422 million, up nicely year over year.
Strong profitability.
So how do we square those, these minor misses on the subscription side within what seems like a really strong quarter overall? Is it just noise or?
That's a really good question. You got to look at the whole context. That slight MRR miss could be a few things. Maybe they're bringing on more smaller merchants on lower priced plans. Or maybe it's just a strategic choice to focus more on driving those transaction volumes, the merchant solutions side.
Cool.
Given how much they beat on GMV and merchant solutions revenue, it feels less like a weakness and more like maybe a shift in the revenue mix. Their transaction revenue is just growing faster than pure subscriptions right now. And just to add another piece here, Shopify often highlights net income excluding the impact of equity investments. It's a non-GAAP thing.
Right. I saw that. Why do they emphasize that number?
Well, that came in at $338 million for Q2, up from $291 million last year. They stress it because it filters out the noise from gains or losses on investments they hold in other companies. Those can swing wildly depending on the market and aren't part of their core e-commerce operations. So excluding them gives you, the investor, a clearer look at how the actual platform business is performing profit-wise.
Got it. Sort of strips away the external market volatility to see the core engine.
Exactly. You see the real business performance.
Okay, that makes sense. Let's shift gears slightly. Where is all this growth coming from? Geographically speaking?
Yeah.
What about the merchants themselves?
Yeah, the geographic breakdown is quite revealing. Shows broad strength, actually.
It really does. Shopify mentioned growth accelerated quarter over quarter in GMV and revenue across North America, Europe, and the Asia-Pacific region.
Pretty much across the board then.
But here's a standout. Europe. It was a major source of strength. GMV there grew 42% on a constant currency basis.
Constant currency. Important qualifier.
It always catches my ear, too.
Hey.
Can you break that down? What does constant currency actually mean for someone listening, and why is it important, especially for international numbers?
Yeah, definitely worth clarifying. Constant currency basically means they calculate the growth rate as if the exchange rates between, say, the euro and the dollar hadn't changed at all compared to last year.
Ah, okay. Takes currency swings out of the equation.
Precisely. It removes that distortion. If the US dollar gets really strong, overseas sales might look lower when converted back, even if the business grew locally. Constant currency gives you a much cleaner view of the actual underlying business performance and growth in those international markets. It shows real market share gains, real merchant adoption, not just favorable or unfavorable exchange rates. It's a truer measure of operational success abroad.
That's a great explanation. So that 42% growth in Europe is genuinely strong underlying performance.
Very strong, yes.
And Shopify's CFO, Jeff Hoffmeister, kind of tied this all together. He said, merchants of every size, from first-time founders to global brands, are choosing Shopify. And their success is what is driving our success.
A classic line, but probably true here.
Does that mean the growth is balanced, like across small shops and big brands?
Right.
Or is one segment pulling more weight?
That's a fantastic question because every size is broad. Hoffmeister's quote really hammers home their core model. Shopify wins when its merchants win. Simple as that. And the data, particularly that huge GMV number, suggests it is pretty broad-based. For GMV to be that high, it means merchants collectively are selling more. So while the press release doesn't break it down by merchant size, the overall strength suggests Shopify is working for a wide range of businesses, from, the person starting out in their garage to big global names using their platform.
Right.
It points to a platform that's flexible enough for different needs, which is key to that ecosystem success Hoffmeister talks about.
It makes sense. Empower the merchants and the platform grows with them. Okay, so what about looking ahead? What's Shopify saying about Q3 2025?
They gave some pretty specific guidance. They're expecting revenue to grow in the mid to high 20s% range year over year.
Mid to high 20s. Still very solid growth.
Definitely. They also guided for gross profit dollars to grow in the low 20s% range, and operating expenses as a percentage of revenue between 38% and 39%.
Okay. And cash flow.
Free cash flow margin, they're projecting that to be in the mid to high teens for Q3. So continued profitability alongside that growth.
Right. These projections, they sound pretty confident, don't they? Like management feels good about the path forward.
Yeah, it signals continued confidence. They clearly believe their strategy is working and will keep delivering strong results. They're not signaling any major slowdown.
And what's really interesting here,
Mm-hmm.
analysts, on average, they were only predicting about 21.54% revenue growth for Q3 based on LSEG data.
Oh, wow.
So Shopify's own forecast is actually more optimistic than what the street was expecting. That tells you something about their internal confidence level, right?
Absolutely. They're guiding higher than the consensus. That's usually a strong signal.
But, and there often seems to be a but when we talk about high growth tech stocks. Despite these strong results, despite the company's own optimism, not everyone is singing Shopify's praises without reservation. The Motley Fool, for instance, offers a, let's say, more cautious take. Why the difference in perspective when the numbers look so good on the surface?
And this is where you really see different analytical lenses at work. It's crucial for listeners to understand this. The Motley Fool acknowledges the strong revenue, sure, but they zero in on a key point. Profits growth is lagging sales growth.
Lagging? How so?
They point out that while revenue grew 31%, free cash flow only grew 27%, and operating profits were up only 21% year over year. So profits aren't quite keeping pace with that top-line surge.
I see the gap.
And their main hang-up, the thing they really stress, is valuation. They say, look, Shopify's $200 billion market cap today prices the stock at 111 times free cash flow and more than 87 times net profit.
Whoa, those are hefty multiples.
Extremely hefty. So for that specific Motley Fool analyst, even with the earnings beat, the conclusion was, Shopify is still a sell for me. And it's really important to emphasize, like you said, this is an external analyst's view. It's one interpretation, focusing heavily on whether the current price is justified by the level and growth rate of profits and cash flow, especially compared to that very high market valuation.
So even fantastic growth isn't always enough if the price tag feels too high relative to the bottom line.
Exactly. It highlights that tension between growth, profitability, and valuation that's so common with these kinds of stocks.
Wow. Okay, so summing up, a really strong quarter for Shopify. Operationally sound, merchants are succeeding, growth is accelerating, and the company sounds confident.
Yep, lots of positives.
But then, these external voices raising questions about valuation, about whether the profit growth fully supports that huge market cap.
Yeah.
It really shows you need to look at these things from multiple angles.
Absolutely. That's the value of digging into these reports beyond just the headlines. You see the strategy, the health, but also how the market is perceiving it. All the optimism and the caution, it's the whole narrative.
Couldn't agree more. Okay, so let's leave our listener with something to think about. Given Shopify's clear commitment to innovation, those bold bets that seem to be paying off, and this ongoing debate about valuation, what new frontiers do you think they might need to explore next in commerce to keep justifying that price tag and continue this impressive run?